look, I want to make it clear that those 7 stocks are up for the right reason. Once again, I mean, they've had a very good earnings recovery, and let's not forget they went through a tough time in 2022. So they've got their costs under control. They have some top line drivers that are unique to those businesses. And it's not just everybody talks about these being tech companies. They're not really tech companies. I would say they're across a lot of different businesses. Advertising, some are tech companies, one's an auto company. Maybe we can go through the list. But the point is that what they have in common is they had positive earnings revisions this year in a year in which most companies had negative earnings revisions. So I think it makes perfect sense. Now, can that continue? I think it's going to be tougher in 2024 for these companies to generate that same relative earnings revision breadth. And that's sort of our view, is that it should either the market's going to broaden out next year and we're going to see better participation from the 493, or the darlings will probably correct a bit more as the valuations come down to reflect what is going to be a normalization of their growth rate. And that's so like our price target for year end next year is not that exciting. It's 4,500, okay, sort of flattish. But there's going to be, once again, we think, a very good stock picking opportunity, probably away from those 7 or 8 stocks, right? There should be more opportunities in the 493.
Can I ask you, though, can we relatively expect there not to be a continuation of the revenue degradation that we have seen for a number of these companies? Because I know in terms of, you write extensively about this, in terms of the fiscal support that has been provided. And obviously, we've got a little bit of a favour coming through from the last issuance and the T-back, maintaining that shift towards bills. Repo sucks up all the T-bills and doesn't cause any kind of problems to that effect. But we've seen this revenue degradation, and it correlates very strongly with employment outcomes at the same time. So you would imagine that those 493 could be in even more trouble moving forward, considering that even though we've seen rates come off, they're still sitting at, 4.5% for the 10-year?
That's right. So look, I don't think it's going to be an easy environment. I think it's a continuation of the environment we've been seeing, which is that, think about it like running a business in this environment, the operational difficulties of, the fastest rate increase we've seen in 40 years. Supply chains are still, somewhat unpredictable. Inventories are higher than normal. You got a lot of carrying costs. Labor markets are tight, so you're paying up for labor. So that's not going to change. So it's not all 493 are not going to have a great year, right? Once again, it's going to be company-specific self-help stories, companies that now maybe have got their head around on costs. Maybe there's some new exciting opportunities at the micro level for revenue, top-line growth. And one thing I will tell you is that while we think it's a flat year from start to finish, it's not going to be flat throughout the year. We're going to have drawdowns. We'll probably have some rallies back and forth. It's going to be kind of more of the same what we've seen. And this all hinges still on the economic outcome, right? So our economic forecast is still no recession next year, but it's not an exciting economic outlook, meaning we're forecasting below kind of potential GDP, and also inflation's coming down. That's going to continue to weigh on revenue growth. So look, it's not a disastrous scenario by any stretch. It's also not like, okay, it's time to load up everything and there's going to be this huge acceleration in growth and everything's going to work collectively like it did coming out of the pandemic. It's going to be more of the same, stock picking, bottoms up driven.